Hi guys, welcome back to the channel. My name is Dave and today we're talking about preferred shares or preferred stock. So if you're a fixed income investor, this can be an attractive investment, but how should you do it? Should you buy the shares directly? Should you buy a fund? What should you do? We'll talk all about preferred shares. If that is what you're looking for, please stick around. Whoop. First off, what is preferred stock? And it's probably best just to use it in a sentence. So I might say, I like the stock Donna, but my preferred stock is Susie. What does preferred stock take to? A company that wants to raise money has a couple different options. One is to issue debt in the form of bonds. Another one is to issue equity in the form of common stock. They also have this other equity option called preferred stock. So just like common stock, preferred stock represents an equity position in the company. You're an owner of the company with your preferred shares. However, unlike common stock, you don't get the benefit of the growth in that company. So if the common stock takes off because the company is growing, don't expect your preferred shares to follow along. You might get a little bump along the way, but it won't be anything compared to owning that common stock. Also, you give up voting rights. And I know every time you get something in the mail, you're jumping on it and you're like, I get to vote. Okay, I don't think I've ever voted in any of those. I'm not very active when it comes to voting, so that's not a big deal for me. Preferred shares or preferred stock, and that's interchangeable, provide a fixed dividend similar to a bond. They're usually sold at a $25 par value per share. Most preferreds are callable at their par value, so keep that in mind if you are buying individual preferreds that are trading above par value. And that callable date is in the prospectus, so check that out if you're looking for specifics on an individual preferred stock. The majority are perpetual as well, meaning they have no maturity date, they just go on in perpetuity. Many preferreds also offer cumulative dividends, which is a nice feature. This simply means that if a dividend is missed to the preferred shareholders, it will be added to the next payment until the full amount is paid out. And while they are doing this, common stock dividends can't be paid out as well. So I just like to look down upon the common shareholders at this point. They're trying to get their grubby hands on my dividends. It's so rude. I don't like it. Waiting for my cumulative dividend to be paid out. And if a company screws up and there is a liquidation event, once again, we are preferred. So dividends preferred, liquidation event preferred to the common shareholders. We have to look down upon these poor folk. But we are behind the bondholders. So it goes bondholders, they get paid, preferreds get paid, and then whatever's left, those scraps, they go to the common folk out there that own the common stock. And speaking of liquidation, as far as failure rates with preferred stock, historically, they are low. This chart is from the Infrastructure Capital Management website, and it shows the 30-year default rate for U.S. preferred securities to be about 0.3%. But what about when the economy is struggling? Well, the default rate during the financial crisis climbed to about 1.5%, which was still well behind that of U.S. high-yield bonds. Preferred shares are interest rate sensitive like a bond, so if rates get cut, just like a bond, that should drive the price of the preferred stock higher, while rising interest rates will drive down the preferred price. Since most preferred stock is callable, this sensitivity to interest rates puts a little bit of a cap on their potential, meaning if rates go down enough, a preferred stock can get called, typically at par, and the company can issue new preferred stock at a lower rate. So preferred shares are a fixed income instrument with lower volatility compared to the common shares. So it can be attractive for fixed income investors that want to take on a little bit more risk, or for the common everyday income investor. So what should I do with this particular class? Should I ignore it? Should I buy some preferreds directly, or should I look for a particular fund that meets my goals? Well, here's what I have done so far. Last year, about a year and a half ago, I bought some Morgan Stanley preferred shares. This particular one right here, trading a little bit above par value at $25.43. So this is a $25 par value preferred share. And I bought this at yields are a little over 7%. It's performed just fine, and that is in my account. I've owned that for a little while. Then earlier this year, I also added ET, Energy Transfer. I've talked about this MLP before. You can go find that information if you're curious about the common stock, but I wanted to look down upon myself and also own the preferred shares. So I bought this one earlier this year. This one yields 7.4%. It is well over par right now at 11.39. So this one's a $10 par value. So they don't all trade at $25 par value. This one's a $10 one that started off at 10. So there are a lot of moving pieces, I guess, if you decide to buy individual preferred shares. So that's something that you're going to have to watch and decide if you want to manage all that. Now, if you want to go the way of the ETF, I wouldn't blame you at all. So I started looking around at the different ETF offerings that are out there. So looking at available funds, the big daddy of them all is PFF. This is the Ishares Preferred and Income Securities ETF. It's the largest preferred with $14 billion of AUM, and maybe I should just buy that. It tracks the ICE Exchange listed preferred and hybrid securities index. It's a mouthful. Has an expense ratio of 0.46% while paying an annual yield of around 6.6%. Does pay monthly dividends, while the ones that I own individually would be paying quarterly. However, while exploring different preferred ETFs, I had the opportunity to talk to Jay Hatfield, who is the CEO of Infrastructure Capital Management, and he's the mind behind PFFA, which is a popular preferred ETF. Now, PFFA adds the A to PFF. That means active management. So that's one of the big differences here. The expense ratio is also different. It jumps all the way up to 2.52%. That's quite scary. But upon closer review, if you look at the prospectus, the actual management fee is 0.8%. And the other expenses that you see here come in at around 1.7%. That additional amount has to do with interest payments with leverage that the fund uses, which is around 20 to 30%. Now, I'm fine with this type of leverage in this case with this type of product. I don't see an issue. You have to determine that for yourself, but I'm okay with the preferred stock ETF using some leverage. Now, distributions for this one are paid on a monthly basis, which is nice for income investors. And they mainly invest in what they call asset-intensive businesses that tend to provide higher yield but low default risk. So again, just use that example of Energy Transfer. That would be a good example, and it's one of their largest positions at the moment in this fund. Total, they have about 150 to 200 positions at any one time in this fund, different preferred holdings. They look for preferred shares that are mispriced relative to the yield while watching the call risk on those preferreds that are trading above par value. That sounds like a lot, but that's why I think the active management can be helpful. And that's where I think this really shines over a PFF, and also why a larger expense ratio probably can be justified. I guess in other words, active management with preferreds makes sense to me. Looking for areas where rating agencies are simply wrong about the risk with a particular preferred, and having an experienced manager make the decision to buy makes sense, versus having me to try to figure it out for myself, or having a fund that simply market cap weights based on an index like PFF does. By the way, all the charts I've been showing come from Seeking Alpha, and I am a Seeking Alpha affiliate. Personally, use Seeking Alpha every day, not just for getting updates on the market, but also for research on the many alternative ETFs that I cover. So if you're looking for a stock and ETF research tool, consider Seeking Alpha and check out the links below for discount offers. And since we're looking at this as a fixed income investment, let's check out and see how stable those distributions have been month over month. The dividend yield from the last 12 months is 9.62%. That's pretty impressive when you consider it's a basket of preferreds plus a little leverage. 9.62%, that's pretty impressive. Dividend history, distribution history, the last 5 years, it's been pretty steady, right? It was 15 cents, 16 cents, and then over the last few years, 17%. So I think for a fixed income investor that's looking for stable distributions over the last 5 years, it certainly has held up pretty darn well. Now, as they say, proof is in the pudding. So is this actively managed preferred share ETF with leverage performing well compared to some other competitors? So comparison of PFFA to 3 other preferred funds over the last 5 years for total return, you can see that this active management style has been working. So we have PFF, which we talked about, up about 19%. Also put in here PGX. This is a $4 billion fund from Invesco. And I threw in PSK, which is from Spider. And they come nowhere near the performance of PFFA over the last 5 years when you look at total return, which is up around 83%. So it is trailing the S&P 500, so it's hard to say, why would I want to be in this? I can just be in VOO. But from a fixed income perspective, nothing comes close to this return when you're looking at some comparable products. So it's doing really well, and you can see all the separation that we have here over the last 5 years. So it's really standing out amongst its peers. And finally, from a tax perspective, I would expect the majority of the distributions to be qualified dividends, although my understanding is not all are qualified. Now, the Morgan Stanley banking one that I showed earlier, that preferred stock, that was all qualified for me in 2024. And talking to Jay Hatfield, he mentioned 23% effective tax rate during our discussion. So that's just an example number. So using that number and based on this 9.62% yield, current yield, that would give us an after-tax rate of around 7.4%. And that is what you keep from what you get. That's important, right? So pretty attractive for an income investor, fairly tax efficient. Also, for a deep dive into PFFA with the fund manager, Jay, check out my buddy over there, Armchair Income, and his recent video. He did a long form video with Jay where they really get into the fun details here. So check that out if you want more information on PFFA. So after a further exploration of this area, am I going to dump all my money into preferred stocks? No, but I think a small allocation to something like PFFA in my fixed income bucket makes sense. So I did. I added some PFFA to go along with my 2 individual preferreds that I own. I personally, after talking to Jay and his group a couple of times, they earned my confidence that they're going to take good care of my money, and I think it's going to be a good investment for me. That's the bottom line. So it works well for me in this way. The risk reward is there. So any questions on any of this, please ask down below. Like and subscribe if you like this type of content, and we will see you next time. Have a great night.